Excellent. Very well. Okay. Hello, everybody. This is the webinar of Network for Sustainable Financial Markets, which is dedicated to the Tomorrow's Capital Markets project, reviewing the incentives of financial markets to promote long-term sustainable value. The speakers of this webinar will be Pat Cleverly, Director of Research, Strategy and Policy at Tomorrow's Company, Anita Dayakova, Senior Research Manager at the Tomorrow's Companies, and Mike Clark, Director of Responsible Investment, Russell Investments. Pat, you can introduce us to the project.
1 second.
Okay.
Okay, so as Daniela has already mentioned, the Tomorrow's Capital Markets Programme is very much focused on two things. One is to look at the incentives, both hard and soft, of those within the system, to actually see whether or not they could be redesigned in some way to ensure that capital is flowing towards sustainable outcomes. And the second is what would have to change in terms of the framework conditions, i.e. the kind of regulations, standards, principles, codes and practices that impact on the capital market system, how they would have to be changed to accommodate any changes in incentives. So I will just move to the next program approach slide. So in terms of the design of the program, it is obviously looking at the system as a whole. Sorry, can you still hear me?
Yes, we can hear you now, but better before, no, we couldn't.
Okay, so I'm on the slide that talks about the program approach. So in terms of how we have tackled the actual program of research, we've broken it into several component parts. One is in terms of understanding what the purpose of the system is about. The capital markets are the natural partner to companies in terms of enabling them to make investment decisions that actually promote long-term value in terms of society as a whole, as well as obviously for their own companies. As part of this, government obviously have a key role to play, and it's primarily about also thinking about the financing required to build the kind of infrastructure and products required that will promote a much more sustainable outcome. The actual outcomes are both first and second order. So first order would be, for example, if we were looking at energy, the actual building of the kind of energy infrastructure which has multiple energy sources rather than a reliance on coal, for example. The second order impact is through that kind of evolution. Of course, it may impact on the business model of the energy companies actually involved. So there are a number of impacts as a result of changing this system. And what we want to do is therefore look at the future state. So one is, what are the challenges that the capital markets and companies together are seeking to address? And what is the current state of the problems in terms of financing those kinds of products and infrastructure? And then to look at the future state. So if this system was operating as we would like it to be, the capital market system, what would it look like? And if you can just switch to the next slide. So in terms of the incentives part, there's a separate piece of work which is focused on the actual incentives themselves. So this is going around the different participants in the system in terms of the chairs of remuneration committees, fund managers, investment consultants, brokers and analysts, and so on, in terms of understanding what incentivizes their current behavior and whether that behavior is or is not conducive to the principles of the capital markets, and what would their new incentives have to look like. If you want to go back. If you hit the arrow and go backwards,
okay, yeah.
back. The other element is looking at framework conditions. So there's the system as a whole and its future state. There are the incentive working groups in terms of looking at the structure of incentives, and then there's the framework conditions element, which is actually saying for this to operate effectively, what needs to change in terms of regulation, etc. If you could click again, please. In terms of the sustainable in terms of the overall approach, we're also building a leadership team. Part of this is identifying the people within the system who already understand that there are issues with the system and actually and can provide leadership in terms of changing the capital markets. And the last element to it is what we call engagement, which is how do we engage across all the networks and all the initiatives that are actually focused on the same issue as we are. So some of you may be aware of things like long-term capitalism or conscious capitalism. UNEP FI are obviously doing work in this space. There is a wider program of engagement where we can actually together collaborate and harness all the activities in terms of shifting the system. Okay. So I'm just going to pass to Annette now, who's going to describe one of the issues that we're looking at.
Okay, thank you very much. Thank you, Pat, and thank you, Daniela, for the kind invitation. It's our pleasure today to be here and to present to your network. What I would like to focus on today is another piece of work we are currently working on, and that is to do with One Share, One Vote, which most of you might be aware of because it has gained a lot of attraction by companies, institutional investors, and regulators in the last years. So what I would like to do is to give a little background. So Kudutaka, if you could please put the particular slide on, that would be fantastic. And I'd like to give a little context and background to the topic. Basically, particularly after the K review, there was a lot of kind of concerns that investors were more focused on short-termism rather than long-termism, which kind of put into question the relationship between companies and their investors. So we as Morris Company in this project, we took a step back to ask the question around how we could engage and encourage more investors to be more long-term focused and how to support more long-term shareholders with the appropriate mix of ownership rights. So at the heart of this question, we're saying it lies the concept of ownership as a valuable asset. So what we're trying to say here is that there is no universal form of ownership and governance of firms, which means that there's no particular ownership which is suitable for each firm. Therefore, every company must be advocating its own ownership, and which is the most appropriate one, which is best underlying the values and beliefs of that company. We think that's at the heart of this first concept. put that in place, companies do need engaged investors, and companies do need long-term committed shareholders. That's for sure. But how do we get there? Is the main question. As I mentioned, I mean, there is a lot of concern in the last year that actually shareholders are not exercising their right to vote. And if you think about it, I mean, institutional investors don't really like committing themselves to continuous share ownership in most cases. For example, sometimes, you know, they would immobilize that particular concept, or they would just tie their hands into a different company just because there are some risks concerning that company. So what we would like to ask here is to explore with you the idea whether there's differentiation in rights, or whether certain class of shares can be marketed in a way that can provide more financial benefits that would encourage more long-term thinking by shareholders and investors. So I'd like to go back to, I'd like to move forward to the main principles that we follow. So next slide, please. So in terms of these principles, which you will be able to see, what I would like to focus on first is to say that companies, as I said earlier as well, companies should clearly set out their purpose. What we advocate in Tomorrow's Company a lot is that companies have to be brave enough to be out there and to get the investors they want. And by that, we encourage the thinking that long-term shareholder engagement should be identified according to the clarity of the owner about the company's objectives and values, and the ability to enforce those values in time and in the long term. If you think about the basics, if you go back to the basics of this concept, the shareholders are the main owners of the company, and in order to exercise that ownership, they need to be there for some time to demonstrate that what the beliefs and values of that company are. They would understand that and reinforce that in time. So that's something quite crucial, we think. As I said earlier, there is increasing concern that the right to vote has not been exercised much. But we would like to ask then, what if shareholders lost their right to vote if it's not exercised? That could act as their encouragement, because if vote matters, then presumably we would have to use it. Since we think that encouragement of long-term engagement ownership is quite important, I'd like to focus more on that concept, and particularly to the fact that large investors should be encouraged to collaborate more and to communicate more with other companies and other investors. And what I've done here is to outline the UK Stewardship Co and the Investor Forum that are focused on that particular issue, and particularly to the collaboration between investors and the way they engage with other investors, how they communicate their strategies, how they think about the company they're investing in, and so forth. We would like to challenge that as well, and to kind of ask the question whether that can actually be creating an honest dialogue, or could that simply create another box-ticking activity? So that's something to think about. Another aspect of this, of course, is enhancing reporting requirements. That, you know, integrated reporting has come into importance in the last year, so that's something to think about. Also, transparency is something very important to understand, to have a better clarity about changes in share ownership, or actually to say who is the person that controls the share and the right to vote. Of course, there are some challenges with differentiation in rights, if you may say. So next slide, please. I'd like to focus on some of them. So while most of the concepts are very attractive to a lot of companies and regulators, The general consensus is that proposing differentiated rights can create as many problems as it can actually solve. And in saying so, we have outlined these particular challenges that I've come across. Probably one of the most important ones to share with you today is from our perspective is the existing mindset of large institutional investors and their advisors. So I could give here the example of France. As you know, enhanced ownership rights were perceived to be mainly used for gaining more shareholder control, and this was used as an anti-takeover device by controlling shareholders, which is something to think about. Another problem that was raised in France was that was a challenge in other countries in terms of not the correct information of a flow of information through the ownership chain and the issue of defining who is the ultimate holder, which goes back to transparency and better reporting requirements. Of course, there is a big issue with unintended consequences, and I've given here an example of stock lending and mergers and acquisitions. It's very important to mention a few things here because if you think about stock lending and, for example, and particularly the economic value of stock lending, there is a lot of fund managers and other participants are making money and they don't feel they have to vote. So it's about disaggregating the economics of the voting rights. So my question here is that in the long-term interest of the company. In terms of proxy voting firms, which has also come as a challenge in the last years, mutual funds are required to disclose how they are voting, and the effect of this regulation has mostly been that funds rely on proxy advisors. So what I think would be a good proposition here is to make or to encourage proxy advising firms to determine their voting recommendations and to explain why they have chosen that way. Next slide, please. So based on that summary and based on the things we've proposed here, we would like to ask you a few questions about what you think about differentiated ownership rights, whether they make a difference and how this can be achieved in practice, and what you think is the barriers and enablers from your perspective, because I know that most of the participants come from different parts of the world. So based in the US, for example, that would be interesting to know. So back to Danielle and the rest of the group.
Okay, thank you. Thank you very much, Aneta and Pat, for your presentation. I think we will be able now to hand over the word to Mike, who I think managed to join by telephone. So,
I can hear you. Can you hear me?
Yes, we can hear you perfectly. Okay, Mike, it's your word. Now Ketutaka will put on your slides. Please go on. You have the floor.
Thank you very much. Well, good afternoon, everybody. I'm an actuary, and I'm going to just give you a little linkage between something that I learned. I talk about financial systems, as many of us do, and I stumbled into a thing called systems theory, which I think engineers developed at MIT. So that's the reason for my slightly flippant title. Maybe I should be an engineer, not an actuary. Slide 2, please. Okay, so this is the world I inhabit. It will be familiar to many of you. There are really four key players that are citizen savers who are beneficiaries of some asset owner, maybe pension fund trustees, and there are investment managers who the asset owners pass the savings, which are now investments, which becomes capital in companies. There are also government and regulators. The key point is that only those four players actually own the money, so anybody else, investment consultants, stock exchanges, custodians, whoever, are sort of helpers, but only four people own the money, and that frames a fair bit of my thinking. Next slide, please. We're all familiar with lots of initiatives in the investment world. I've listed a few here. You'll be familiar with those. You'll have your own list. Let's move on to slide 4. And some clicks, I think, yes. So what is a system? It could be water going to a bath. It could be our brains. It could be the system I described earlier. So systems are just things with stocks and flows and other bits and pieces. So the next slide, please. Now this is where, using the work of Donna Meadows, who was one of the authors of Limits to Growth about 30 years ago, the piece that I found very helpful to organize my thinking is the way that we can intervene in a system, and here I'm going to talk about the long-term savings investment capital system. So the higher you are, the more powerful the intervention is, but the harder it is. The lower you are, it's pretty easy to do, but you don't have much of an effect. So if we started with the rules, say, rules is the 5th one down, it's regulation. It's not actually as powerful as self-organization. If a group of us get together and agree a sort of common path, that's probably going to be more powerful than rules which we may try and avoid. Information flows are important. A lot of the work being done is around transparency. Feedback can either reinforce change in a system, or there can be balancing feedback which sort of resists change. And we're talking about stock and flow structures. And I found this very useful. If we can move on to the next slide, please. To plot, I've taken some of the initiatives I'm familiar with across the top, United Nations Principles of Responsible Investment, the UK Stewardship Code, and I've listed those 12 intervention points on the left-hand side and asked the question, where did these interventions start? And that's the gold star. What sort of things did they change? That's the blue blobs. A bit later, what other things may they have had an effect on? And that's the green blob moving up. Because typically, you affect things immediately lower down in influence, but over time things may change in the more powerful regions. If we take an example, the UK Stewardship Code started as a rule. The FSA, now FCA, said here are some rules, and asset managers will actually publish their response to the Stewardship Code. Over time, the market decided that wasn't enough, and in a self-organizing sort of way, set up the NAPF Stewardship Code, which got more information flows, more feedback, because reinforcing feedback is often competition in this world. If the asset manager next door is doing something, then maybe I want to do it too for competitive reasons. And I've just found this very useful to organize my thinking of what is a sort of large canvas. One of those interesting ones, which is still in its early days, is the one I've headed Metrics and Models. Some of you will remember the K Review in the UK. Well, recently, the government department responsible for the K Review did a review of how we're going. That's BIS, Department of Business, Innovation and Skills. One of Professor K's recommendations was metrics and models in investment management are not fit for purpose. BIS have published a research paper, I think it was numbered 190, and the sort of feeling I get is that the paradigms that the investment world works in, so we could talk about alpha, beta, standard deviation, CAPM, efficient markets. The hypothesis is that Mrs. Smith, the citizen saver, who the asset owner gathers her savings in and passes investment managers, she doesn't really care about that. And all the sort of responsible investment, ESG, sustainable stuff is gradually evolving the paradigm in which this world, some of us work in, all of us work in, is evolving beyond what I unkindly call Chicago Finance 101. So I've just found this a very helpful chart to plot any initiative, sort of where's it going, which part of the world in, is it the accountant doing something, integrated reporting, is it stock exchanges doing something, is it the Montreal Carbon Pledge, which was asset owners self-organizing, and just sort of seeing where it starts, what effects it has. And if you time to move on to the next slide. These are just sort of summarizing some points to think about. I I represent an asset manager a fair bit of the time, but this approach actually helps me to think from outside the system. So although I will maintain an asset management point of view, I can somehow think from somewhat outside the system. What you'll see is that many of those interventions improve information flows. There's lots of conversations about transparency. I think it's helpful to think about regulation, and I'm suggesting here that good regulation promotes good behavior. Bad regulation probably forbids bad behavior, a big generalization. But if regulation can encourage good self-organization, that's more powerful than just making some rules. I've already mentioned that interventions can generate reinforcing feedback through competition. We've seen with the Montreal Carbon Pledge, if a large French pension fund becomes a signatory, maybe another large French pension fund does, because the chairman wants to make sure that their scheme is a signatory too. I think it focuses a lot on beliefs, and I know we're familiar with a lot of work being done on investment beliefs. And I guess as a sort of last rather big question, which we couldn't possibly address today, it actually gets us to think, what do we mean about value? At the end of the day, how do we determine, how do we define, how do we measure, how do we manage value? And that is all I've got to say. Back to you, Daniela. Thank you.
Thank you, Mike, for this presentation. Very interesting indeed, all the key presentation. I will ask the audience to, if they want to write their questions, they can start writing their questions in the window which you see on the right side of the screen. And then we can also hand the word to them. Let me start with a question to Mike, straightforward. You, in the slides about the levels to intervene in the system, you are saying that the strongest level in terms of power, but it's the harder to achieve, is the gold sparrows and the unparallels. Whereas the one which has less power, in some ways easier to be achieved, is numbers. My question to you is the following. How does it come that it's so difficult for the responsible investment community to get to a full integration into financial analysis of ESG into fundamental financial analysis? I am saying that because myself, I am a financial analyst who thought of the relevance of corporate governance and ESG in a certain time in my development of career, and so I realized that those aspects were very relevant for long-term value creation. But from the slides you have now here represented, it seems that it's very easy to get numbers, whereas I have the feeling that everybody is discussing about numbers, but we are getting, we have difficulties in getting to a consensus and getting to really a model done. What do you think, Mike, please?
Okay. Well, I think what I'd say is that the paradigms in different sort of parts of the system are sort of different and incomplete. So let's take two examples. I sort of grew up in my career as an actuary, but then got to financial economics and learned about, alpha, beta, and all that stuff. That doesn't cope very easily with climate change risk, for example. We tend to use models, we tend to use past data, but in fact the risk of let's say, carbon risk exposure isn't really captured in past data because we don't have much in financial terms. So many of us who, if you like, think about that, find it difficult to engage with the models that the investing community uses. And I would say that was one of the themes of the metrics and models point I made right out of the K review. If you go to another space, in UK trustees, UK pension fund trustees, there has been a long feeling that any of these slightly sort of softer things were out of order. Basically, the trustees' goal, and its only goal, was to maximize returns in a financial risk framework. When they talked to their lawyers, they looked at the McGarry judgment, the Scargill judgment of many years ago, and since trustees are by nature cautious and lawyers are by nature cautious, basically this item never really got on the agenda. So if we look at the work the Law Commission did last year in the UK, they sort of said, not so really, not so. But I think this is just a system with lots of inertia, and there certainly are changes if you look at the sort of growth of UNPRI signatories, if you look at discussions that we're having now that we didn't have 3 years ago, if from the point of view of my own firm, I tell you how many RFPs have ESG stuff in it, I think we just have to accept that there's a long, slow process where each bit of the system is moving along its path, but the more we can accelerate a long-term view which comes from SIPs in the UK for trustees, and in fact in Canada they have SIPs. So as the asset owners begin to develop, I sometimes call it managing their supply chain. We're very used to that concept for companies, but asset owners can manage their supply chain as well. Then I think we have to just accept progress will be slow, and maybe the challenge is to find ways where, if you like, in our individual bits of the system, we can help to accelerate that change.
Thank you, Mark. We have another question by Rob Lake. Investment beliefs that refer to ESG, and many do not, are seldom logically linked to beliefs on things like drivers of long-term returns, preferred investment strategies, and so on. What are your reflections on that? If you want, Rob, if you want to be, if Kazutaka, you want to unmute Rob, and maybe he can...
Sorry, I didn't quite catch the question. Is my computer has just frozen? Is that question written down, or can you just repeat it?
Can you hear me, Mike? If I
Yes,
intervene here,
you're very clear there.
Okay. Yeah, my observation is that where funds have formal investment belief statements, and many do not, where those belief statements include references to ESG, and in many cases they do not, even where they do refer to ESG, very often they don't appear to be logically connected to the other investment belief statements that might refer to things like sources of long-term return, or preferred investment strategies, or the institution's role as a participant in the market. And I just wondered what your reflections were on
that point,
on that phenomenon, whether you share that observation, and
is that Rob Lake?
why that might be. Rob Lake, yeah.
I thought it was, yes. I saw Rob, but it sounded like you. I think this ties in with the previous question from Daniela. I think that because, if I may put it this way, you and I grew up with Chicago Finance 101, and the world has thought that way for a generation, we are struggling to, if you like, integrate these things. I think it is perfectly acceptable to try and get to some beliefs. I guess I looked at the CalPERS ones about a year ago, and part of the challenge is you've got to start with the beliefs and then actually work out a bit later what you're going to do with them. So I think the CalPERS beliefs do refer to carbon exposure risk, yep.
They do.
So once you've stated that belief, I'm prepared to give them, as it were, the slack as they work out what that means in practice. So what, we might expect with any asset owner who did that would be, maybe they will run a piece of their portfolio passively against the low carbon index. Maybe, as we've just seen in Australia, where there's a proposal out for a global equity mandate with 50% carbon exposure footprint versus a standard index. I think there's lots of experimentation, and in some ways we are used to having an overarching framework of what I unkindly call Chicago Finance 101. And to your point, it is disjointed. Nobody sort of knows, and we're going through a sort of mass experimentation period. You know, we know what the Environment Agency Pension Fund have done in the UK. I could refer to one or two sort of Russell Investments client examples. People are just trying different things. And to begin with, the responses tend to be what I might call a product response, because they can't pull the whole pieces of the portfolio to join up. And that will happen over time, but they're recognizing that their previous way of looking at the world is incomplete. And they're just sort of taking some baby steps, and gradually over time, those will build up more coherently. So, for example, you know, we're beginning to measure carbon footprint to the asset owner level, but that's pretty new. Does that sort of help a bit?
Sure, no, that makes sense. There's a conversation for another day. We should get together and catch up, Mike. I think it's also interesting that the way investment beliefs are framed when they do refer to ESG differs. Some seem to be very stock specific. They operate at the stock level, and some are much more holistic about the system as a whole.
I think that's a very good point, and you and I would probably prefer the holistic approach. It's just harder, and you can put effectively a stock-specific type view in a mandate. So if you were an asset owner and said, Mike, run me some money this way, we could have a sort of mandate, benchmark, guideline conversation for that piece of your multi-billion portfolio. It would have been a lot harder for you to have done all the work to get up to the top and then work out how to come down in various strands and have a detailed conversation like the first one I just mentioned, if that makes sense.
Yep, thanks.
It's easier to make it, if you like, a product conversation with an outcome. You know, here's a mandate. It's much harder to sort of do the work and not sort of know where you're going, but just trust that you'll get there, 3 to 5 years later.
Thanks.
Thank you. Thank you.
Thanks, Rob.
I don't see other questions from the audience. Please, if you want to raise a question, please write on your right side of the screen. Let me ask a question now to Pat and Aneta about tomorrow's capital markets project. This is a relevant engagement project among financial markets participants, namely regulators, asset owners, asset managers, financial analysts, consultants, beneficiaries of pension funds, etc. Which degree of welcome did you have by each single category? Whose incentives you have been analyzing? And which kind of further cooperation are you looking for also by Network for Sustainable Financial Markets members?
Okay, thank you, Daniela. It's Pat here. I'll start. I think different participants, I would say that they have the same level of interest, but their agendas and their business models are in different places at the moment. So, for example, the investment consultancy industry is very much in transition in terms of moving towards what's known in the UK as fiduciary management. Pension fund trustees, as Mike has already alluded to, have the time to engage with the project. So they're probably much easier in terms of their involvement. Fund managers, I would say it varies very much, again, depending on what type of fund manager you are. So, I think it's hard to give you a catch-all answer. What's quite critical to us and what's important is actually the number of people who, once they are aware of the program, have come to us and actually said, I am very interested, let's have a chat. Because what it's telling us is really what Mike alluded to, is there is momentum for change. It's probably in different pockets. Some of it is quite niche at the moment. some of it is what you would call mainstream. So from our point of view, it's finding those people, yes, who are critical within the system, but critical in a positive way in terms of seeking, to achieve change. In terms of how the network can help us, I would say, regardless of what participant you are, we are looking for interesting ideas, interesting input, and engagement as part of this greater engagement process that we're involved in, which is about connecting people across the system. Does that answer your question?
Thank you. Yes, please. Thank you. I have a question by Sarah Cleveland.
I've seen that. Shall I have a go at that, Tanya?
Okay, Sarah, okay. If Sarah can speak, otherwise let me read it. What's the role of investment consultants? They tend to be laggards rather than leaders, yet the asset owners are not pushing their supply chain.
Well, Danielle, you'll have to cut me off here because I could do 10 minutes on this. I'll try and do it in 90 seconds. In the UK, many people would say the role of investment consultants was inadequate. I would slightly challenge Sarah's assumption that they're naturally laggards because, in a sense, they should be anticipating their asset owners' sort of next request. I quite agree with Sarah's point that the asset owners are not pushing their supply chain. We could have this conversation in various countries, but in the UK, most asset owners, as in trustees, are probably more interested in de-risking and the next deficit payment from the finance director. And this has a number of implications. As Pat said, in the UK, there is quite an evolution of business model by investor consultants, and that probably gets in the way of some of this, because actually, as my firm has evolved and is now an asset management firm, not an investment consulting firm, many other firms are still in that transition. So, for example, some of you will be familiar with the Smith School, where I happen to represent the UK actuarial profession on their Global Advisory Council. They have got a project speaking absolutely to this point, where they're investigating the investment consultants as potential barriers to green investment. I'm aware that the FRC have had a look at investment consultants and possibly the inadequate role they are playing in relation to promoting the Stewardship Code. So I think, and I guess this is because I'm a sort of ex-investment consultant myself, there is quite a focus on the people who should be helping to change the world. The investment consultants, their defence will say, to Sarah's point, if the asset owners are not pushing their supply chain, we can't possibly invest in the intellectual capital which we can then sell to our clients because we don't see any revenue. I have to say, with one UK investment consulting firm, that has been very apparent because people sort of expect information for free. What I can say is that some of the ESG data providers, so pick your favourite, Truecost, MSCI, Sustainalytics, FTSE, they are increasingly consulting in this space. They consult the asset owners who suddenly get a richer view of the world, and to Rob's point, they begin to develop beliefs based on what they've learned through that consultation process, which actually is sort of product marketing. And the asset owners, and we've had experience of this, can then come directly to investment manager because, frankly, the investment doesn't have a lot of value to add because many investment management firms have let us call consulting skills to bridge the gap between the solution and the belief. So I think it's a really interesting question, and I think we're going to see a lot more on this issue, certainly in the UK, in the next sort of year or two. Different considerations apply in different countries, but I'm going to stop there.
Thank you, Mike. It's a very interesting point you're making. Let me ask, if there are no other questions from the floor, let me ask one last question to Pat and Anita. It's concerning exactly if you present a project to the regulator in the UK, and which was their reaction. And the second question is, in what extent is this project exportable to the EU or other jurisdictions according to your first assessment so far?
Sorry, Daniela, can you repeat the first question, please?
Yes, the first question is if you present the project to the regulator in the UK, which was the reaction on the project? Or I think you, if I recall correctly, I think you had the presentation in the Houses Parliament. Maybe I'm wrong, but not, well, Houses of Parliament is not a regulator, but anyway, it's public administration. So we're thinking if you had some feedback also from the, let's say, the government or the public administration on the project.
We haven't, in terms of the first report, Daniela, that was launched at Rio 20, but wasn't formally presented to the regulators as such. In terms of this particular second phase, which is about getting to a different level of granularity, obviously the FCA in the UK are aware of what we're doing, and it fits very much with their focus on values and behaviours within the investment system. But at this point in time, whilst we've had a number of discussions, it will be over the next month or so that we will be in a position to have the first set of worked up proposals to discuss with the various different regulators, policymakers, etc.
Yes, thank you. And do you think about, the next question is, do you, what extent is the project exportable to EU or other jurisdictions, according to your first impressions?
Yeah, that's a really good question, Daniela. What we, because of the scope, as you can imagine, that this is a global program, because the capital market system is a system across the world. What we chose to do was try and come up with an EU UK set of perspectives and recommendations from change first. Then we can take that into different jurisdictions and then work out what is different. So, for example, Annetta earlier mentioned, you know, France in terms of their differentiation of share owners' rights is different. So what we need to do first of all is have something that works in one geographical territory, and then we would take that in some way through to America and other territories, and then test what we would have to be different.
Thank you. Okay, so I think we have finished for today. Thank you very much for those who have been participating to this webinar, and thank you very much to our speaker for this very interesting introduction to the Tomorrow Capital Markets project. We, as Network for Sustainable Financial Markets, would like to support you. So if you wanted to have us engaged in the project, I think it's we are delighted to do that.
And thank you. And if anyone has any comments, thoughts, ideas, please do contact us. And thank you all for your time.
Thank you. Thank you, everybody.
Thanks, Daniela.
Bye-bye.
Thanks, everybody.